Gross rents is good to look at, but I would not bet the farm on gross rent. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, I'm going to be discussing the 1% rule. This is another metric that is really, I don't want to call it the third rail of real estate, very similar to cap rates. It's a very controversial metric. I remember back in the day, 10, 12 years ago, if you weren't buying deals with the 1% rule, people thought you were crazy, you were overpaying. But as we've seen the market elevate and if we've seen prices go up in a lot of markets, you can't hit the 1% rule. So if you want to know what the 1% rule is and any other metrics that you should be looking at when you're underwriting deals, listen on. Thanks for joining me here, because this to me is one of those topics that it's a great rule of thumb, but it's so hard to say, hey, the 1% rule is great in one market and not in another, because to me, it is market specific. In certain markets where prices are really lower and cap rates are a lot higher, the 1% rule can be achieved very easily, simply. In other markets where assets are trading at much lower cap rates, 1% rule is going to be a lot harder to hit. Now, should you be hitting the 1% rule? To me, that depends. It depends upon what your strategies are, what you're trying to accomplish, what your goals are, what the markets are. But before I go on any further, what is the 1% rule? Simply put, if you're buying an asset for $100,000 per unit, you're achieving at least $1,000 per month in rents. It's really the purchase price, which is $100,000 times 0.01, 1%. That you will achieve $1,000. As I said, when Jake and I started out, you were hitting 1% rules. I remember the very first deal that we did. It was a $25,000 per unit property. We were generating $400 a month in rents. I mean, think about that, how insane those numbers are. Now you look back then, well, why was it the case? Well, the case was it was really hard for financing. It was really hard to raise capital. There was a lot more risk in the market. So prices were really a lot lower. You were able to achieve the 1% rule. Now, when Jake and I look at a deal in our market, we're looking at these deals, and let's say a deal comes across our desk, depending on the vintage. Let's say it's an older vintage, a 1970s asset, where we know we're going to need to put additional capital into this asset to fix it up. And let's just throw out a hypothetical number. Let's say the number is $100,000 per unit, and this asset's only getting $800 per month. Well, it's 0.08. It's not yet the 1% rule. But let's say that Jake and I need to add $10,000 to this property to get it to $110,000 per unit with CapEx and with fixing it up on average. So now we're into this property all in at $110,000 per unit. Now, if we know that we can get those rents to at least $1,100 or even $1,200, and in some cases $1,300, exceeding the 1% rule on a post-renovation reposition, then that warrants another look. But for us, it's not really that exciting if we're looking at a deal that we paid $100,000 per unit and there's no value add. We can't get it to the 1% rule, especially on an older asset, because the older assets are going to need a lot more maintenance. And the funny thing is, right now in this part of the market sector, if you're buying assets in the 6.5%, 7% interest rate, if rates are at 3%, and you're able to secure debt at a 3.5% rate like we did years ago, and you're achieving the 1% rule based on those interest rates, man, that deal is going to make a ton of sense and a ton of money for you. Now, let's look at the newer assets. I can give you an example. An asset that we had just bought back in July, 2018 vintage. Asset was trading at $145,000 per unit. That's what we paid. Now, ingoing rents were $1,200. So we bought it at a little less than the 1% rule going in. And you may be saying to yourself, well, how did you do that? Off-market deal, seller was motivated, we met his price, and we knew there was enough value add that we can get rents up. So you may be saying, where did rents go? Well, right now, rents are exceeding $1,400. So we've exceeded the 1% rule. But what's even better with this newer asset, you're able to not worry about deferred maintenance. These turns, the turn cost on these is very low. So you're exceeding the 1% rule on a brand new asset with very little deferred maintenance going forward. That to us is something that we'll always look at. But when you're doing your underwriting and you're looking at it, it's a quick decision. If you don't want to spend the next 3 hours underwriting a deal, this will give you that idea. Now, another metric that we used early on in our career is called the gross rent multiplier. Another metric, it's called, we should have called these metrics pre-screening. So the gross rent multiplier, simply, you're taking the price of your property divided by the annual rents. So the price of the property, let's say for instance, is $1 million and your annual rents are $100,000. It's $1 million divided by 100,000. You get a 10 gross rent multiplier. You're paying 10 times the rents that you're achieving. Now, as the properties get more expensive, let's say you bought a property for $1 million and you're only collecting $50,000 in rents, you're getting a 5 rent. So what you're trying to do is you're trying to get properties with higher gross rent multipliers, right? The only issue with gross rent multipliers, very simplistic, once again, you're looking at the 1%, then you look at gross rents. It doesn't take into account vacancy. It doesn't take into account your expenses. It doesn't take into account, let's say the property did have $100,000, but you can get them to $200,000. Now you're buying at 20 gross rent multiplier reposition. You're just taking a snapshot in today's time. And it's the same thing with the 1% rule. But with the 1% rule, I like to extrapolate out and go out 18 months. Gross rents is good to look at, but I would not bet the farm on gross rents. It's just something pretty nice to see. And what it can do is if you're underwriting deals in your market, and it's just a quick one, take a look, but you have to analyze apples to apples. Because if you don't, you're analyzing a 2015 build, which is brand new, to a 1970s asset, which is really old. You really can't use the gross rent multiplier or the 1% rule with those assets because it's going to look crazy. You're going to pay more per price for this newer asset, so the older asset's going to look a lot more attractive. The flip side being that older asset comes with a lot more issues. It may not come with as much value add as the newer asset as far as terms of holding that asset long term. Now, we've talked about the 1%, the gross rent multiplier. The next one that I like to talk about real quick is debt coverage ratio. It's another metric that if you're not achieving a 1.25 debt coverage ratio, which means basically you're earning 25% more than what the debt is on the property. If you have a 1.00 debt coverage ratio, banks don't like that. What's basically happening is you're earning enough on this property just to cover the mortgage payments. There's nothing left over to pay for any expenses. So when you're looking at a property, you're looking at the debt DSCR. Most banks want to see at least a 1.25 and higher. Now you may be saying to yourself, well, what happened to all those deals over the last 2 or 3 years that are now having problems with this floating rate debt? They couldn't achieve a 1.2 debt 5 on the purchase price. So what did they do? They went out and got floating rate debt and ended up talking about, the property's buying it today. In 2 to 3 years, when all the work I've done, the work that I've achieved, I will achieve a 1.2 debt 5 coverage ratio once it's stabilized. Very risky. You're seeing a lot of those deals coming back only because they didn't get enough rate cap insurance, and or the rate cap insurance expired, and or rates went up real quick, gave a shock to the system, and or expenses went up really quick. So it's one of those things that Jake and I like to preach: long-term fixed rate financing. We passed on a few deals over the last couple of years. Thankfully, we did. Debt coverage ratio is another one of those metrics. There's only 2 things you can do to get that debt coverage ratio down. You can either put more down. Let's say your LTV is 75, you got to make it 65, and or you've got to drop the price. Those are 2 things that you can do to get your debt coverage ratio down. But banks want to see at least a 1.25. They want to feel comfortable. They want to make sure that you're earning enough money on this property to be able to pay them and then to be able to pay the expenses. The next one is cap rates. I've done extensive videos on cap rates. If you want to find out and listen to more about cap rates, go back to the how-tos and the Jake and Gino show on cap rates. It's another metric, a snapshot in time where you're trying to compare properties that are very similar without debt. Great number to have, but I would not bet the farm just on cap rates. The next one is cash on cash return. I actually just did another video on that. You're looking at total cash inlays to the property divided by how much you've put into this property. So let's say, for instance, you've got $1 million property. That's what you purchased for. All in, $1 million. You've got $100,000 in net profit coming out of that property. You take the $100,000 divided by the million, your cash on cash return is 10%. Now, Jake and myself, we love cash on cash only because we are investing our cash. We aren't doing syndications right now. We're not raising capital from any outside investors. So we're focusing on cash and this next metric, which is profit per unit. We've discussed PPU many times in the how-to. Profit per unit is how much you are profiting per unit. We like to shoot for between $200 and $300 in profit per unit, depending on how much leverage you have on the property, depending on how well the property is running, depending on if the property's been repositioned. That's what our stabilized PPU number is. That's what we're really shooting for. We've been averaging between $250 and $300 in profit per unit. The final metric that most investors love, especially those who are syndicating and those who are raising capital, is an internal rate of return. IRR is a snapshot using the present value of money, and you're going out, you're extrapolating out. Typically in this market cycle right now, you're looking at anywhere from 12 to 20% internal rate of return. It's looking at all the cash flows you make and is looking at an exit 3, 4, 5 years out. And most people, when they hear about IRR, they're always thinking about an equity multiplier of 2 times. So if you put $100,000 into a property year 1, by year 5, you want to be able to have doubled that money within 5 years through the cash flows of the property and through either a sale or a refinance of the property. IRR is a great metric. It's another metric that we've done videos on. What I've tried to do here in this lesson is try to arm you with some metrics and some formulas that we use to analyze deals. Let me go through them real quick. Number 1, the 1% rule. Really love it. Number 2, gross rent multipliers. We do use it, but not really. It's one of those where you should start using it when you're underwriting initially in a market to get some idea of where prices and where rents are and start analyzing, but it's just a quick metric. The next one, DSCR. Absolutely going to use it all the time on every deal. That's how you're going to secure debt for your financing. Then there's the cap rate, cash on cash return, profit per unit, and internal rate of return. Now, if you have any questions or comments, please leave them down below in the comments section. I'd love for you to subscribe, give me a like on the channel, give me a like on this video, and I will see you all on next week's How To. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.